Welcome, curious minds, to another deep dive.
Great to be here.
Today, we're plunging headfirst into the fascinating world of high finance.
Specifically asset management.
Or exactly. We're looking at one of the real behemoths, Blackstone. We've got their Q2 2025 reports, earnings summaries.
And some peer data, too, I see. BlackRock, Invesco.
Yep, got those lined up as well. So our mission today, it's not just reading numbers off a page.
No, definitely not.
We want to pull out the key takeaways. What do things like earnings, assets under management, what do they really tell us?
About their strategy, their health.
Right. And how does Blackstone actually stack up against the competition in this space? Okay, let's unpack this.
Sounds good. We'll look at what's driving their performance, maybe any, hurdles they hit.
And then zoom out a bit.
Yeah, exactly. See how it compares to BlackRock and Invesco for the same quarter. That should give you a really solid picture of the whole sector right now.
Perfect. Okay, so Blackstone. Right out of the gate, they definitely made headlines. Their second quarter 2025 distributable earnings, they landed at $1.21 per share.
And just quickly, distributable earnings, that's basically the cash profit they can actually hand out, right?
Yeah.
Dividends, buybacks.
Precisely. It's a really direct measure. And that $1.21, it didn't just meet the forecast.
It beat it. The exact consensus was $1.10, I believe.
That's the one. And maybe even more impressive, that's up 26% from the same quarter last year. A big jump.
And you saw the market react almost instantly, didn't you?
Yeah, the shares rallied, almost 2% in pre-market?
Yeah. Which, clearly signals investors thought this was genuinely better than expected, not just a minor beat.
So drilling down a bit, the report points to two main things driving this.
Let me guess. Revenues and AUM.
You got it. Higher segment revenues and a really substantial rise in assets under management, AUM. But, it wasn't all totally smooth sailing, was it?
No, not entirely. I mean, those top-line numbers look great for sure.
But
they did flag an increase in GAAP expenses as a bit of a headwind.
Okay, GAAP generally accepted accounting principles, so standard reported costs.
Right, the usual costs of doing business, basically. But despite those rising costs, their net income, the actual profit attributable to Blackstone,
That still went up.
it surged. $764.2 million. That's up a remarkable 72% from the year-ago quarter. So, underlying profitability, still incredibly strong.
Okay, let's dig into those revenue numbers then, because they do tell a story. Total segment revenues hit $3.07 billion.
Which is, 22% up year over year?
22% jump, yeah. And again, beat the Zacks estimate, which was $2.75 billion.
So pulling in more money across their business lines.
Definitely. And on that GAAP basis we mentioned, revenues were even higher, $3.71 billion. That's 33% growth.
That really does showcase their ability to generate income from different places. It's not just AUM growth. They're making money off that growth.
Good point. But then there's the other side you mentioned, expenses.
Right, the other side of the ledger. Total expenses, GAAP basis, $1.93 billion.
Which was up 18% year over year.
Yeah.
So you see the pattern. Revenues soaring, yes, but costs are climbing too. It's that constant balancing act at this scale.
Makes sense. And thinking about their financial stability, their flexibility, the sources give some big numbers.
Like cash on hand.
Yeah, as of June 30th, $10.6 billion in cash, equivalents, treasury investments, plus another $20.5 billion in cash in net investments.
Okay, so very solid footing.
And they've got that $3.6 billion undrawn credit revolver too, just, ready if needed.
Extra flexibility, always good to have.
Those cash figures, they definitely paint a picture of stability. But for an asset manager, the real headline grabber is often AUM, right? Assets under management.
Well, absolutely. That's the empire they're building.
And Blackstone's numbers this quarter were, pretty eye-popping. What stood out to you there?
Well, two key figures. First, their fee-earning AUM, the stuff they actually charge fees on,
Great.
that grew 10% year over year, hit $887.1 billion. Solid growth.
Okay, and the total?
The total AUM, this is a big one, an astounding $1.21 trillion. Wow, trillion with a T.
Trillion with a T, and that's up 13% overall.
Mm-hmm.
And importantly, this wasn't just markets going up.
No.
It was mainly driven by huge inflows, net inflows of $52.1 billion just in this one quarter.
$52 billion in. That's a massive vote of confidence from investors.
It's huge.
Yeah.
So, okay, more assets. That means more potential fees down the line, and crucially, more dry powder for new investments, right?
Exactly. The sources mentioned $181.2 billion in undrawn capital.
Committed money,
Yeah.
just waiting to be deployed.
Precisely. Gives them immense firepower to jump on new opportunities. It really highlights their capacity for, future deals, future growth.
Makes sense.
And they were active on the shareholder front, too, buying back some shares.
Oh, yeah. How much?
About 0.2 million shares repurchased in the quarter. And they still have authorization for another $1.4 billion worth of buybacks.
Which usually signals management thinks the stock's a good value.
Often, yeah. It's seen as a sign of confidence. Okay, so we've picked apart the Blackstone numbers. What's the outlook? What does this all mean looking ahead?
Well, the Zags analysis suggests, they're pretty well positioned for more top-line growth.
Driven by that AUM momentum.
Primarily, yes. Continued AUM growth, strong fundraising ability.
Yeah.
But, there's that familiar but.
Let me guess. Expenses.
You got it. The outlook expects those high expenses, plus just a generally challenging operating environment could potentially squeeze the bottom line, at least in the near term.
So growth is there, but profitability might face pressure.
That's the gist.
Yeah.
Which is reflected in their rating. Blackstone currently has a Zacks rank #3. That's a hold.
Okay, explain the Zacks rank quickly for everyone.
Sure. It's a short-term stock rating. #1 is strong buy, #5 is strong sell. #3 hold basically means analysts expect the stock to perform roughly in line with the overall market. So stable, but maybe not set for huge outperformance right now.
Got it. Neutral stance, which kind of leads perfectly into the next question. How does this compare to their rivals?
Yeah, that's the key context, isn't it? How did the other giants fare?
Let's start with BlackRock, another absolute titan. Their Q2 adjusted earnings, $12.05 per share.
Which handily beat expectations, right? Consensus was $10.66.
Yep, surpassed $10.66, and that's a solid 16% increase from the same quarter last year for them.
And similar drivers for BlackRock. Revenues up, AUM up.
Seems so. Results boosted by higher revenues, and their AUM hit a new record high, $12.52 trillion.
$12.5 trillion. Wow.
Driven by, again, inflows, market appreciation, and they even got a little help from favorable foreign exchange rates.
But did they mention expenses?
They did indeed. Higher expenses were noted as a headwind for BlackRock, too.
Okay, so theme emerging here.
Definitely seems like it.
Yep.
Now, what about Invesco? Slightly different scale, but still a major player.
Right. How did they do?
Their Q2 adjusted earnings were 36 cents per share, which actually missed the Zacks estimate of 40 cents.
Oh, okay, so they lagged.
Yeah, and their bottom line was down 16.3% compared to last year's Q2. So, kind of a different story for Invesco.
Interesting. And what hurt their results? Was it?
Higher adjusted operating expenses. There's that theme again. That was the main drag.
Wow. It really is across the board then.
Seems like it. Though on the positive side for Invesco, they did see a rise in adjusted net revenues. That helped. And their AUM balance also increased thanks to solid inflows.
Okay, so even with the earnings dip, they still pulled in assets. That's crucial.
Absolutely. So we've looked at Blackstone in detail, glanced at BlackRock, checked on Invesco. What's the big picture here? What's the main takeaway when you line them all up?
Well, you definitely see this consistent story playing out, don't you?
Powerful AUM growth.
Powerful AUM growth, yeah, fueled by really strong inflows across the board, pretty much. That leads to rising revenues. But
yeah,
everyone seems to be grappling with this persistent challenge of rising expenses. It's like this high-stakes game. Grow the assets, grow the revenue, but keep a lid on costs.
So even these giants aren't immune to operational cost pressures.
Not at all. It shows how competitive the market is and the cost of operating at that massive scale.
Understanding these dynamics really helps you, the listener, sort of grasp the tightrope these firms walk. It's not just about scooping up assets.
No, it's about managing the costs that come with that growth efficiently.
So this deep dive, it's shown us the, incredible scale and growth, but also these very real common hurdles.
Exactly. It reminds me of that old saying, revenue is vanity, profit is sanity.
But cash is reality.
Right.
Or something like that.
Something like that. It's about keeping costs in check to actually keep the money you make. So maybe a final thought for everyone listening.
Go for it.
If rising expenses are this consistent headwind, even for the biggest players like Blackstone and BlackRock, what kinds of creative solutions or maybe strategic shifts might we see them try in the next few quarters, to tackle those costs and boost the bottom line even further?
That's a great question. How do they get more efficient as they get even bigger?
Exactly. That's something I think we'll be watching very closely. They could really shape their strategies going forward.